Thank you, Hannah, and thank you for being here today. Can everyone see the first slide? Good, good. Well, your folders with the regions have a couple of different products from EMSI in it. One's the Economic Overview Report, which we uploaded a couple of weeks ago. There's also a table, an Excel table of industry data from EMSI. And I want to spend some minutes today talking about some of the components of it, how you can use it in analysis, and to answer some questions. We hope this will be a resource for you when you're looking at the region that you're in and some of the trends that are happening there. So we're going to cover an introduction to EMSI industry data and its use, some of the data definitions in the industry and how we classify companies, employment trend analysis, understanding industry concentrations, and then Q&A. So first off, the EMSI data that we have is really a useful tool. Why don't we use just the Bureau of Labor Statistics information? Well, the Bureau of Labor Statistics is an excellent source. It's actually the foundation of information that is used in EMSI and other tools to build data about our industries in our state and in our regions and counties. It's the best source, but several laws protect the confidentiality of that information that the Bureau collects to make sure that companies aren't identified. So, for example, the NAICS, the classification of an industry, cannot be disclosed. Also, if a company is a large employer in a sector in a certain area, that information can't be disclosed. So the Bureau has a lot of this information hidden because of that reason, which makes it hard for you when you're trying to understand your area, what some of the big industries are when some of that information isn't disclosed. Also, EMSI includes self-employment estimates. So we'll talk a little bit more about that in some coming slides, but a lot of times self-employment is an important part of a regional economy, and so EMSI adds that as well, so that's nice. And then finally, EMSI provides faster estimates of industry details than the Bureau does. Now, the Bureau has a really good set of information called the Quarterly Census of Employment and Wages. It's where you get a lot of the details of industries and wages and trends in your area, but that information lags 6 to 8 months. So EMSI takes that information and then makes estimates faster than what you'll get from the Bureau of Labor Statistics. Now, I gave the information to you in the Excel that has 2015 to 2020 data. But realize when that data for 2020 was cut, the Bureau of Labor Statistics had only put out 2020 first quarter information. So EMSI is using that information to benchmark and to make estimates. So really look at this stuff as pre-COVID numbers. In the coming months and quarters, they'll be updated to more information. The information and some of that data is in the Excel sheet about what quarter was used to do the analysis. It'll say EMSI Q4 2020 data set, but really they're looking at the latest available data from BLS, which is first quarter 2020. And then also down in the parameters tab, you'll see what the data includes. So it includes the QCEW data, which is Bureau of Labor Statistics data, non-QCEW employees, which is railroad workers, some federal employees and so forth, and then self-employed. So it's a little bit broader than just the BLS numbers. So how can you use this information? Well, today we'll talk about the analysis and the tables, and hopefully you can get some comfort level in using the tables itself just to understand your regions. We'd love for you to use this in presentations, so to take some of your analysis and then use that in your presentations that you have for your stakeholders in the community. But realize you can't just send out the Excel sheets to people outside of the MU Extension organization. That's against the license policies that we have with EMSI. So use it internally, use it for presentations. So we'll start with industry data, definitions, and classification. So your Excel has a couple of tabs. The first tab and the second tab are around the different industries. One tab is the 2-digit NAICS. The other tab is the 3-digit NAICS. And we'll talk a little bit more about those distinctions in the coming slide. But the NAICS is a description of the primary economic activity of that establishment at that location. It is also ordered. So the NAICS starts at digits like 11 for agriculture and forestry and fishing and hunting, 21 for mining, 2.2 for utilities, 2.3 for construction, and so forth. And it's an ordered description. So it's kind of neat in the fact that goods producing NAICS are close together. So mining, construction, manufacturing are goods producing. Service producing are also grouped together after that. And then you have government at the very end. So that order is actually helpful in understanding sometimes how to look at the data by knowing that order. There is a category for payroll business locations. So payroll business locations are companies that employ people and have a payroll, and they'll report those numbers to the Department of Labor. It covers about 95% of non-agricultural workers that are wage and salary, and about 75% of agricultural wage and salary workers. It does not include the self-employed and the self-employed with no workers, importantly. For jobs, we have 2015 and we have 2020 jobs. Jobs are full-time and part-time jobs, so it's the whole group of that. A person can also have multiple jobs, so you can have a job at a fast food place in the evening, for example, and also work your day job at a manufacturing plant. So it's not an actual count of people, it's a count of jobs, and so those are the jobs that are there. There's percent change, there's number of change, and then there's earnings per job. So earnings isn't the same as wages. Earnings is wages plus benefits, plus income to proprietors, and all of that total amount of earnings is divided by jobs to get that earning per jobs. So if you're looking, for example, for a specific job title, there's different sources that you can use for wage rates for different jobs. Industry classification is the next topic I want to cover. Really, why do we classify companies the way we do? So the North American Industry Classification System is called NAICS, and that's what we use to identify the primary economic activity of an establishment at that location. So that's an important concept to think about. It's really the primary economic activity. So for example, over to the right, you see, what is O'Reilly's? Well, we know O'Reilly Auto Parts is a retailer of auto parts across the Midwest and many parts of the country. So it's going to be classified in many places, including Springfield, as an auto parts retailer. But it's also a headquarters company, and it's going to be classified as a headquarters company in Springfield as well. So you're going to find management of companies as a sector, and it's likely that O'Reilly is going to be in there. It's also a distribution center. In Kansas City, they have a distribution center, so it'll be classified there as a distribution center along with those other parts retailers. And then finally, what it isn't, though, is it isn't a classification of what O'Reilly sells to. So we don't know if O'Reilly sells products to NASCAR or if they supply, a different company here and there. We don't know what companies do in terms of their markets. We just know their primary economic activity. And that's an important thing to understand. So when you're looking at your data, you may know a company in your area and you go, this is the company and this is what it does, or this is how they sell products. But realize that they may be classified in different NAICS, and they may be in multiple NAICS. A lot of very large companies break out their units by the different activities they do for reasons of insurance, for reasons of tax credits, and so forth. So you'll really see this with large companies. Now, when we're looking at the NAICS is ordered from 2 digits down to 6 digits. So 2 digits is the highest level. So think of manufacturing as a 2-digit sector of 3.1, 3.2, and 3.3. If you want more detail, the second tab shows 3-digit NAICS. So you can look at manufacturing, you can break that down and go, okay, I see that food manufacturing is 3.11, beverage and tobacco 3.12, and so forth. So that number has an order, and that order is important. And the numbers will roll up. So all of your 3.1s, when you total that in your 3.1 and your 3-digit NAICS, will sum up to your 2-digit NAICS numbers. Now, when you look at the jobs, you'll see that there's jobs there, then there's some places where you'll see less than 10 or insufficient data. That happens when there's really just not a lot of information for EMSI to estimate what those numbers are, usually for very small industries. So for example, in this slide, you see that There's insufficient data for textile mills. There's only 2 payroll business locations, really small, less than 10, and there's insufficient data. Now, this is important because even though you can get down to very detailed NAICS, usually we're staying at a 2, 3, or 4-digit level to analyze information. And that's for a couple of reasons. One is there is limited data on some industries as you get down lower. Also, as you get to really highly detailed classifications of companies, you're just looking at that primary activity, but a lot of companies have multiple activities. Take a 3M manufacturing plant. The one in mid-Missouri region produces at least 3 different products, and sometimes they're going to different types of industries and different types of things that they're making. So when you get really detailed, you sometimes erroneously think, I've got this company really defined, but maybe you don't. Maybe it really does a lot of different things. And so we kind of use the higher level of analysis to understand that some companies are more complex than just one category. Now, this resource, there's a NAICS resource, a little button there. It basically goes to a Bureau of Labor Statistics site where you can look at the NAICS in detail. Importantly, it tells you what a company is when it's described by that NAICS, but also what it isn't. And so that's a helpful resource. And I use it sometimes when I'm trying to help describe a company. All right, so that's the background on industry classifications and definitions. Now let's look at employment trends. So employment change over time is one of these key things that we're, of course, very interested in. How has that industry changed over a time period? And we use generally things like 1-year time frame, 5-year time frame, 10-year time frame as some general rules of thumb for doing analysis. These Excel sheets use a 5-year time frame, and that's a good time frame to hit a large part of the growth of our economy and the business cycle from 15 to 20, to look at our regions and how they were changing over that time period. So the very first thing you want to understand is, of course, the actual change in jobs. The actual change in jobs between those 2 periods, and that is in that column, 2015 to 2020 change in jobs. So you're going to look at that and look at the industries with the largest increases and decreases in jobs, and also keeping in mind the total amount of change in jobs for that region. So for example, in this region, there was 16,000 jobs added over that 5-year period, and 2,700 of those were in manufacturing. So that's a pretty significant number. You also want to look at percent change, which is included, and that's just percent from 2020 to 2015. So over that big time period there, you have that change. Looking at the percent is good. Looking at the percent alone, however, is misleading. So if you look at mining, for example, it's well above the average growth for that region. The region grew at 4%. Mining grew at 20%. That's great, but you also want to look at the number of jobs that was 92 jobs out of 16,500, still pretty small. And so looking at that percentage along with the total change is an important thing to realize. A lot of times when I'm looking at a percent change, I am looking at the regional average, in this case 4%, and looking at which ones grew faster than that, and which ones grew substantially less than that as well. Now, there's a lot of reasons industries grow. There's regional aspects to it. There's also national aspects to it. And then there's some more detailed industry analysis that can help unpack that. But we're not going to get into that today. But it is a good concept to understand how does this industry change relative to all the industries in that region, and then looking at that in terms of the number of actual jobs. So next thing I like to do when I'm analyzing industry data is I like to look at patterns. There's a lot of information there, and so you could try to sort each row, but I don't like to sort, at least not initially. I like to start off by keeping things in the NAICS category. So I look at goods producing, such as agriculture, mining, utilities, construction, and look at manufacturing, look at those groups together. Then I'm looking next at retail, wholesale trade, transportation, warehousing, and following all the way down to services, healthcare, and so forth. So I like to look at it from that way because just in my mind, I can see the structure, a little bit of how the economy is made up there. Then I want to look at the total jobs there, because industries with the large jobs are obviously very important. So I'm going to look at those and look how they changed. Now, I also want to look at the growth and decline, those percentage changes that we looked at. I do care about earnings too, because earnings are important. Earnings are a large part of a local impact of an area. If you have an industry with 100 jobs earning 80,000 in earnings versus an industry with 100 jobs earning 40,000, there's going to be much bigger impact in that local economy on spending for those jobs that are in higher income paying industries. So I want to look at that as well. So one of the things I like to do is conditional formatting. That's something you can do in Excel. You can highlight those rows. You can tell it to conditional format, and it will give you a quick glance, green or red or different colors if you like, of what some of the change, what some of the different relative numbers are in this spreadsheet. So if you look at this one over to the right here, this table, this is one of our regions in the state. And you can see from 2020 jobs that there's really a lot of employment in a few sectors: manufacturing, retail trade, healthcare, and government. Also accommodations and food services is pretty large. Now, over that 5-year period, you can see which ones grew. So we have healthcare growing really substantially with 5,000 jobs, accommodations and food services also growing, and manufacturing growing well as construction. So a lot of sectors that were growing pretty well. Some sectors like administrative support, not growing, actually shrinking in pretty substantially. And then information, finance, and so forth. Now, if you look over at the percentage change, you can see also that those ones that dropped substantially also had some drops in percentage, especially administrative support, 9% drop. And then if you look over at wages, you can see what were some of the higher paying wages. So utilities are always a very high earnings type of job. Not a lot of jobs in utilities, and you don't really expand that too easily. So it's something to know, but you're really not a lot of times doing anything with that information. But it's nice to know. Management of companies, headquarters companies are high paying jobs, and so you can note that. Healthcare, pretty high paying jobs, as well as manufacturing and other things. So all this together is helpful to understand kind of the change in this region's industries and how that all relates. And so I love to do conditional formatting to look at that. Now let's talk about industry concentrations. So industry concentrations are important for a lot of reasons. One, it can indicate a specialization in your regional economy. It can also help identify export-oriented or basic industries. And what I mean by that is industries that are really there but are exporting their goods or services outside your region, and that therefore bringing new dollars into your region. So that's what economic development is in many ways, looking to expand those export-oriented industries. Sometimes they're hard to define though. Manufacturing is traditionally an export-oriented industry just by definition. So is agriculture by and large. There's obviously some types of agriculture that's just for the local market, but by and large, it's considered an export-oriented industry. But what about professional technical services? That's your accountants, your lawyers, and so forth. Well, a lot of times they can be export-oriented if there's a lot of those industries in that area, more so than you would expect. Then you can assume that some of that is probably export-oriented. It can also, though, identify vulnerabilities in the region. So especially as you get down to smaller areas, you may see a very high concentration in one industry. It may be one company. And so that's great in terms of while that company is there generating jobs and obviously having a concentration, but if that one company were to move, you would quickly be in a very vulnerable situation as a regional economy. So we understand about concentrations through location quotients. They tell you about these concentrations by measuring the relative concentration of an industry in a given place. And we usually compare employment, and we're usually looking at that compared to the US average. There's different ways to do LQs. Occupational location quotients are available. You can do LQs from different regions, but I'm going to show you how to do the US one, just so you know the math behind it here. The location quotient is included, and we'll talk about what that number means in another slide. So location quotient calculation is really a very simple calculation. It's a calculation of the region's concentration versus the US. So this is a manufacturing example. You have industry employment over total employment in the region over national industry employment and national total. So, for example, in this region, let's say we had 20 manufacturing jobs out of 100 jobs. In the nation, let's assume we had 100,000 manufacturing jobs out of a total of 1 million jobs. These are obviously just made up numbers, but it goes to show the actual math here. So in the region, 20% of the jobs are in manufacturing. In the nation, 10% of the jobs are in manufacturing. So simply dividing that 20 by 10 gets you 2, location quotient of 2. And that means that region is 2 times as concentrated in manufacturing employment as the US average. So that's just a quick thing on the map. Location quotient tips. So here's some general rules of thumb. Location quotients of 1.2 and higher are generally indicators of some degree of specialization. LQs 0.8 to 1.2 are really kind of generally matching the US trend. So if something's 0.9 or 1.1, we're really kind of saying, yeah, it's pretty close to the national average. If it's less than 0.8, it may indicate that there could be a deficiency in that region. But it depends on the region size and industries. So at very small regions, at a county level, or even 2 or 3 or 4 counties, you may find very high LQs. And again, it could be just one company that's employing a lot of people in that. So you want to look at that with employment as well and payrolling locations. Not all industries are going to be found in all places either. So you may be in a place where mining is just not going to be there, and that's okay. It doesn't mean you're deficient in it. It's just that it's not going to be there. Headquarters companies are a lot of times focused in cities. Bigger cities, the more of those. And so a lot of times you're not going to find a lot of those in the area. So if you look at the table to the right, this is one of the regions in Missouri. We see some high LQs really in transportation and warehousing, in manufacturing, and those are really the highest ones. We see it starting to get a little higher in retail trade and accommodations and food services. So just so you know, if you see concentrations in accommodations and food services, entertainment, and retail, that's usually an indicator that tourism is the draw. So it's not that those industries in and of themselves are the draw, it's that there's a tourism aspect to it. Arts and recreation are a lot of times a draw, but accommodations and food services and more retail go with that. And so you would see this, for example, in the Branson area, you would see a higher LQ than that. And then you can see things that it's not so big in, especially in mining, like that example. We don't always have mining everywhere. And educational services, in this case, it's going to be your private education services and not your local schools. So location quotients give you at an instant a really quick way to look at the industries and which ones are concentrated, and to tell you a little bit about how your area is different perhaps than the US. And so I think it's a helpful measure to have in there, and it's included in those tables as well. So please take a look at the tables and understand a little bit of how that analysis happens, and then you can use some of that information in presentations, hopefully, to help your stakeholders. All right, so with that, it's time for questions and anything that we have on the chat. Happy to answer any questions here. Let me look at the chat here.
Yeah, I don't see any in the chat at the moment. Oh, Bob Swartz just said, talk more about the license and sharing data sheets and what we can and can't share. Right.
So you can share the economic overview report, the PDF file, because that's in a format that the data cannot be manipulated. So it can be given to someone and shared with them. Data that is in a format that can be manipulated cannot be shared. So that's an Excel sheet or a data file from EMSI. So you can use it internally, and that's the goal, for you to use it internally to analyze. You can make PowerPoint presentations from it. You just can't share the Excel table outside of the extension. And please unmute yourself too if you have a question. Love to take your questions. So.
Alan, in your example with O'Reilly's, you said that it may be reported in multiple NAICS codes. So are those numbers then double counted, or are they split out? So like retail split out and management split out?
Good question. They are split out.
Okay.
They are split out. And you won't always know if a company is split out or not. I mean, you know, the data is not going to tell you, but just understand that there will be data there that will be in probably NAICS that you don't assume that they're going to be in. And so the reason why that's done, just to kind of back up, why do we do it that way? Well, the economic activity is easiest thing for them to describe. What do you actually do there? And I take that the primary activity is really important. So it's 50% or more of that activity in that place. So a 3M plant's a great example. They are very diversified in what they make. They could have a plant, and under that shell could be 3 different products in very different types of processes to develop those products. They could be classified differently in the NAICS code. However, the NAICS definition is going to be by the most predominant economic activity. And that's why using a higher level sometimes is helpful. But it is split out. And a lot of times this is really going to be a challenge in big urban areas like Springfield, St. Louis, and Kansas City, where you'll find the Boeings of the world, the Monsantos, Anheuser-Busch, these really big companies, Enterprise. They could be in very different sectors. They could be in headquarters. They could be in IT services. There's a lot of IT back-end office work, especially with headquarters. They could have a lot of different breakouts of their industry that could be in there, but they're not double counted. So.
Okay, thank you. And then another question I have is okay, so I understand, you know, where the NAICS codes come from, but who identifies them? So can they be misidentified sometimes? I mean, are they self-identified by the employer, you know, or?
Well, it's a good, super question. No, so the office I used to work at, Merrick, was the Bureau of Labor Statistics state office for identifying the NAICS of industry. So when a company starts or modifies itself and it reports to the Department of Labor and says, I'm starting a business and I'm going to employ 10 people. And so they start employed. Then the Department of Labor comes over to Merrick, and the Bureau of Labor Statistics folks there call that company and say, all right, tell me what you do. And through that process, Merrick assigns a NAICS to that industry. Now, is it perfect? No. But there's a lot of work that goes into identifying that NAICS. And it's really important because that NAICS also then defines the staffing of that industry, because that same group, Merrick, also calls and asks about the staffing. And so a headquarters company has a lot different staff than an auto retailer shop would have. So you have that, that's important. So that's a sign, and it has a lot of implications for insurance. For example, a manufacturing company is going to have a higher insurance cost than, say, an IT firm because of the potential for worker injury and so forth. So there's a lot that goes into a company's consideration of a NAICS, but actually companies generally don't try to or want to game the system. They really want to tell what they do because it's just going to be evident in how they operate anyways. And so that's how it's assigned. It is assigned by a Bureau of Labor Statistics person in a method that is used across the US.
Okay, thank you.
Ellen, I have a question on so I'm in the Joplin area, and so I know I haven't looked at the tables yet, so I apologize for that, but my area would be more interested, is not really my triads, but I would say the Four Corners area that they call, which goes beyond my triad. So how do you recommend that I use those tables? And is that going to be easy for me to kind of mix different counties if I want to look at that and discuss issues with people in the area?
No, that's a good question. If you have a select group of counties that you want to look at differently, just email me and I'll make sure you get an Excel sheet with that. We wanted to start off with a standardized look at things, and of course regionalism is really important, because when you get really down to very small, just county level information, there's some misleading ways you can look at data. One is a lot of times you don't see all the information because there's just not enough data points to tell you about an industry. And secondly, it really, a lot of people commute outside their home county to work. And so where you work actually matters a whole lot. And so when you look at it from a regional perspective, you're kind of grouping up that movement, commuting patterns as well. So you're taking the whole of the economy and looking at that, which is important. You don't want to look at it too narrowly and not understand that people move. I think it's been years since we did this, but I think at one time there was the estimate that 70% of people leave their county every day to go work and come back. So that's a large, so, you know, a lot of places people leave their county. So that's different than the employment numbers that are in your specific county. There's different ways to look at that. But to your answer, email me and I'll be happy to cut a table for you in those different areas that you need.
Thanks.
There's a question in the chat from Misty Ritter. So she says, if your area is deficient in a certain area like healthcare, can you also assume they're deficient in the services provided through healthcare and the care provided? Or is it really, can you only just look at jobs associated with that and not really the services provided by it?
It's really just jobs. So going back to that, that slide about what the NAICS is and what it isn't, it is just the activity that's happening there. It's not really how well they're servicing the area or what those services particularly are for that area. So a ambulatory healthcare facility is going to be your doctor's offices. One doctor's office may focus on care of elderly, for example. Another one may focus on different types of things. The NAICS is not going to tell you that. So a lot of times what I tell people is you want to use this information in conjunction with your local knowledge about what's happening on the ground, because there's things happening on the ground that this data will not capture. So you want to use your combined knowledge of this data versus what might be a critical challenge on the ground, and know that you can't always do something about some of this information, or at least not easily. It is just what it is, but understanding how your region relates to the larger region and to the US is important.
Just had another question come into the chat.
Jeff asked, will we be looking at regional input-output models in the future sessions? And are there RIMS models available to us to use in some regions of Missouri? RIMS, so RIMS is a supply chain analysis, if you will, of what industries buy and from the industries they buy from and so forth. The EMSI does have that ability to do that. So if you have a specific industry, now it's really down to a very specific industry. So if you have a very specific industry and you want to know generally what do they buy from, for their services, there is information that I can get out of the EMSI that will give you that input-output types of numbers. I say that, but also with the understanding that what you buy locally and what you buy from outside your area, this model also makes some assumptions of. So just because you have a Ford plant in your area doesn't mean they're buying all their paint supplies, all their glass supplies, all their dashboards from the local area. So the model will say, well, you may need X amount in dashboards, for example, but it's going to assume, it's not going to assume all of that's made there, obviously, in that region. It's going to estimate that a lot of that's coming from outside the region. But yeah, and so that's helpful for some people if you want to know information about that. It's really specific to the industry, though. So you really got to zoom in on a very specific industry, as they're not very broad use tools. And then number of payroll business locations. Why is it reported as locations and not businesses? So that is the number of businesses in that location. I'm not sure, maybe Robert or Bob, if you want to tell me what you mean by that.
Yeah, I was just looking at the one table that you had shared, Alan, and I thought the heading on the one column said business locations. So maybe I'm misinterpreting the heading, that's all.
Yeah, it's just the number of business locations there. So, and just, really quick aside on locations, it's the locations of the establishment. So O'Reilly's can have 20 establishments in a region, and that would be 20. It is one firm. So it is one employer, O'Reilly's. And so that's different than the actual establishment locations. But what you're seeing there is the establishment locations.